Warren Buffett is well known for focusing on durable businesses that can maintain value over the long term. Even when they face temporary setbacks or unexpected headwinds, the key question for him is whether the business can survive structurally. So today, I want to ask a simple question. Japan's trading houses are huge, complex, and invest all over the world. How do they manage failure? Today I'll explain how risk management actually works inside Japan's trading houses from the perspective of someone who works there. I'm Shosha-man. I currently work as an employee at one of Japan's 5 major general trading houses. On this channel, I don't speak as an external analyst or commentator. I explain Japan's trading houses from the inside for investors. That internal perspective is the biggest point of differentiation of this channel. When I speak with overseas investors, I often hear the same concerns. Aren't trading houses too diversified to manage properly? They invest heavily in emerging markets and resources. Isn't that risky? If a huge investment fails, wouldn't it be fatal? From the outside, trading houses can indeed look like a bundle of risks. But what is often misunderstood is that they are actually organizations designed from the start to live with risk. From the outside, Japan's trading houses may look large and stable, but from the inside, their history is not one of uninterrupted success. It is rather a history of repeated failure, bold investments, businesses built on incorrect assumptions about the future, external shocks far beyond what anyone expected. Trading houses have always operated right next to risk. In the 1990s, as Japan's economy stagnated, trading houses faced serious criticism. Manufacturers began expanding overseas directly, reducing the role of intermediaries. At the time, people genuinely asked, do trading houses still have a reason to exist? This period later came to be known as the Winter Era of Japan's trading houses. The failures of trading houses did not begin in the 1990s. They go back much further. In the late 1960s, during Japan's high-growth era, energy demand was expanding rapidly. Against this backdrop, Itochu made a large-scale investment in oil refining through Toa Oil. At the time, the decision looked reasonable. Demand was growing, and the project aligned with national policy. However, structural changes in the oil industry and deteriorating market conditions in the 1970s turned the investment into a long-term burden. IJPC, Iran-Japan Petrochemical, was a massive national-level project launched in the early 1970s. Mitsui & Co. was a core sponsor and operator of the project. But political and geopolitical risks, most notably the Iranian Revolution in the late 1970s, overwhelmed the project. The business failed not because of operations, but because external forces destroyed its foundations. These failures left a powerful lesson. Scale, national backing, and growth potential alone are not sufficient measures of risk. One defining feature of trading houses is that failure is never treated as a matter of mindset alone. Instead, failures are analyzed systematically. Why did it fail? Where was the judgment wrong? Which warning signs were missed? These cases are formalized as case studies and incorporated into training and investment review processes. In internal training and on-the-job education, past failures are discussed openly and concretely. Failure is not hidden. It is treated as an asset that protects future investments. When people hear risk management, they usually think only about investment decisions. But in trading houses, risk management is also very practical and mundane. One example is credit management. Trading houses conduct daily transactions such as selling raw materials, purchasing products, entering into long-term contracts. The key question is simple. Can this counterparty really pay? Will they honor their commitments? To answer that, trading professionals repeatedly visit customers, gather information not available publicly, sense what is happening on the ground, information from the field, not just financial statements or news, is taken extremely seriously. This field-oriented mindset also applies to investment management. investment does not end at execution. Trading houses send people on site, monitor management continuously, intervene early when problems emerge. Compared to private equity funds, this is a major advantage. Trading houses are not purely financial investors. They operate as business owners. That perspective significantly reduces risk. There is another important point that is rarely visible to investors. Clear exit criteria. In many trading houses, there are explicit internal rules such as, after a new investment or business launch, if losses continue for 3 consecutive years, withdrawal is, in principle, considered. These rules are not applied mechanically in every case, but they exist to prevent projects from continuing indefinitely without accountability. Warren Buffett does not look for companies that never fail. He looks for businesses that can maintain value over long periods of time. Japan's trading houses do not forget past failures. Embed lessons into rules. Prioritize field-based information. Are willing to exit. For long-term investors, this structure provides a great deal of reassurance. Japan's trading houses are not low-risk companies. More accurately, they are companies designed to coexist with risk. That is why they have survived repeated crises and continue to operate globally today. On this channel, I explain Japan's trading houses for investors from the perspective of an active insider. If you found this helpful, please subscribe and like the video. I'll see you in the next episode.